Straight to our next caller. We've got Jeff on the line from Melbourne. Hi Jeff, what's your question for us tonight?
Good evening, Chris. Thank you for taking my call.
No problems.
Firstly, just like to say, fantastic quality information for the last few years. It's been a great benefit for me, but more importantly, I just want an honest appraisal of the uranium sector for with relevance to PDN. I'm starting to accumulate large stocks of that. I just want to know what the panel think of that.
Mate, thank you very much for your comment. Roger, is there any of these you'd touch yet?
No, you're not going to like.
You're not helping me, mate.
Sorry, buddy. Look, I'm in the business of trying to invest with low risk, and the way I do that is by buying what I think are high quality businesses when they're cheap. Now that doesn't mean that your recommendation won't make money. It just doesn't. It's not a game that I'm playing. So I walk onto the field and you're playing baseball and I'm playing a different game. So that's fine. But from my perspective, Paladin's going to generate next year a return on equity of 6% or 6.5%. The year after 7.5%. I'm looking for a margin of safety, so I'm trying to buy businesses that can generate returns on equity that are greater than the discount rate that I use to value those companies. So if I want to try and make 15% return in the market, then I'm looking for businesses that can generate return on equity of greater than that. Paladin doesn't meet that for me.
And any general uranium comments?
Look, yes. I think actually the very long-term story for uranium is actually a good one. News came out about Japan that the disruption at Fukushima had nothing to do with the wave, and it had already been cracked and ruptured prior to that. You just don't build them on fault lines, and then perhaps you'll have a more stable situation. But it is for want of an alternative that can provide baseload energy, the closest thing to providing that for us in the event that we run out of fossil fuel, or that the climate changes so fast that we have to stop using fossil fuels.
Fair enough.
Other fossil fuels.
Fair enough. We'll go to Ian from Parramatta. Hi Ian, what's your question for us tonight?
Oh, g'day guys, thanks for taking my call. Got a question, more of a fundamental valuation from Roger, if he could help, on Mincor Resources, stock code MCR. Noticed that they've been really beaten badly technically, and they dropped out of the ASX 300 last week or the week before, and they've got about 100 million cash. They had some issues, some mine issues in one of their Kambala nickel operations in Western Australia, but they've just they've got 100 million in cash, and they've done a deal I think in PNG for a copper and gold sort of tenements. So just wondered what Roger thought on that.
No worries. Listen, thanks for your question, Ian. Look, Mincor has been the flavour of the month a few times before. It was a reasonably performing nickel stock. Look, I know I haven't been in it recently. Is it Mincor? What does it look like?
It's an okay business. I got it rated as an A2.
Oh, okay. It's quite high
in terms of quality, so it's good. But it's at the lower end of A2. It generates a return on equity of only about 13% or 14%. Well, that's what it's expected to generate, and that's been lumpy in the past for obvious reasons. The valuation, that pullback that we saw in the price has actually brought it back to its intrinsic value. I've got an intrinsic value for 2012 of 89 cents, so it's trading around that level now. It was expensive for many years. In fact, it's been expensive since the middle of 2009. July 2009, it's been over its intrinsic value. It's only just coming into its intrinsic value now.
Okay, one of the big news today was Catalpa, which was actually going down the road of a merger with St Barbara Mines. That was CAH. And today, obviously, the boys at Catalpa weren't particularly happy about this deal. I don't know whether they were going to lose their jobs or something. However, they've announced a merger with Conquest CQT, which immediately saw Catalpa drop from $1.70 down to around about $1.44. They're bidding 0.3 of a share for each Conquest share. But the kicker here is that Newcrest is actually vending in 2 of their own mines into this new company in return for a 30% stake. So despite Catalpa getting beaten up today, I just don't know whether this one might now be one to watch. Roger, did you get a chance to look at that today? Look,
I'm disappointed in a business whose intrinsic value I think is going to rise significantly, merges with something that isn't going to rise significantly. it's always my concern. I think we're bereft of wonderful businesses in Australia, and when a good business disappears, or a business with some potential disappears, or gets mixed in with a whole bunch of other things, and it gets blended together, I just have to wait for everything to settle down again and have another look at it. Thankfully, there are enough other opportunities to distract me from worrying about this one.
I think that's a pretty good...
But its intrinsic value was forecast for 2013 to go to about 23%.
Oh, okay.
Sorry, not intrinsic value. Return on equity was forecast to go to about 23%. And as a result, the intrinsic value was going to jump quite a bit. At the moment, it's expensive compared to what it's worth. But by 2013, I had intrinsic value jumping from $1 to almost $2.
Okay. Okay. Well, Headland, thanks for waiting on. What's your question for us tonight?
Yeah, thanks, fellas. I'm a longer-term investor. I like looking at what will be good, 10 years from now and that. My question's about Galaxy Resources, lithium.
Yep.
I just wondered if any of you had any views about that, please.
Any lithium in your portfolio, Roger?
Thankfully, no.
No.
No, you didn't put any.
No, I didn't put any.
No. All right, so
chirpy pills.
Exactly. So this is a business, and I take the caller's point that you do want to buy businesses whose intrinsic value is going to rise, and that'll happen when they start earning money. If there's an immediate prospect or a prospect that they're going to earn some money in the next 18 months, then I'd take another look at it. I don't have any forecasts for it. Yep. So at this stage, their demonstrated track record is that they haven't made any money. I can't give you a positive valuation on it.
Yeah, that's Peter, how can we help you?
Hi, Chris. That's just more of a broader question directed at Roger, if I can. He's typically asked about intrinsic values of individual stocks. I'm actually interested on the intrinsic value of the index, in particular the XJO or the XAO, the All Ords, or the top 200. Is Roger able to give a forecast or an intrinsic value for 2011 and also for 2012?
Great, thanks very much, Peter. Now, Roger, can you just quickly add up all 300 of the companies and work it out for me?
I've already done it.
You've already done it. Excellent. Okay.
5,202.
There you go.
I'm not joking.
5,202
based on analysts' expectations for all the stocks that make up the 200.
Yes, yeah.
Based on those expectations, if you aggregate all of those, you get an intrinsic value for the index for 2013. I've got 5,202.
Rightio. Okay, there you go. I didn't expect to get an answer off that. So that was going to be my next question, actually, Roger. When you do that calculation, do you then come up with is that your 12-month target for the index?
No, I don't have any targets.
Or that's just...
I have to confess, I have no idea where the market's going to go.
Right.
All I do is say, okay, well, that's one valuation. I should say that's a valuation based on analyst expectations for those 200 companies in 2 years' time, 5,202. If we look at the average performance of the companies, all the 200 companies that make up the index over the last 10 years, and if we project that forward and say, well, that average performance is going to continue, well, the valuation's more like about 4,500.
Right.
So somewhere between those two numbers is probably right.
Yes.
But I don't know whether the market will go down before it gets there or whether it goes up and then comes down to it. I just don't know.
Okay, I think that's fair enough. Good stuff. Thanks for your question, Peter. We're going to sneak in another email right now, and this email is from Liam. Liam was really hoping someone from the panel could give some insight into Kimberley Rare Earths. Recently floated at 20 cents and for a week or two traded above that. Since then, it has slumped to a close of 15 cents today. I picked up a lot of the shares at the 19 cent mark, wondering why this stock has fallen so much after such a successful and oversubscribed IPO last month.
Just in relation to the comment, the idea that a successful IPO means that the share price is going to continue to perform well is a mistake. And it may be that it was oversubscribed because investors thought that it'll do well on the back of Lynas being very close to production and China restricting supply to Japan and the United States. In response, Japan's moving production of its products to China, which is what China wants strategically. So all of that means that there are some rare earth prospects that can come on the market, capture some capital, and then potentially go and do something with it. But if they're a long way off production, then there's no doubt that they'll have to raise money again.
Yes.
And if they're going to have to raise money again, then people who've bought in the float, they'll try and take their profits and wait for that second opportunity. So just because it comes on at a premium or it's oversubscribed doesn't mean it's going to list. Another one recently was On the House. On the House was oversubscribed, but because of the way the market was, it listed at a discount. It's
With the shares free for that? Yeah.
Realestate.com. What's that?
On the house with the shares free for that?
No, they weren't. No, but it's a realestate.com.au type competitor. And it listed at a discount despite the fact that it was oversubscribed.
Right, yeah.